Hi, welcome to PlanStrongerTV. I'm your host, David Holland. Do you have it all figured out financially? You know what you're doing? Know how to get gains, how to avoid losses, how to make sure everything is just right? Excellent. Thanks for stopping by. For the rest of you, I'm glad you're here. We're going to dig into how to make sure that your retirement is all it can be. Dennis Miller will join me. Let's get to it. Welcome back. Looks like most of you rejoined me. I'm glad. You don't think you have it all figured out. Well, guess what? Neither do I. I've been in the financial field since 1991, and I'm still learning. And that's okay. That's a good place to be. The thing that people get in trouble with is when they think they have it all figured out. Maybe you know some people like that. We all do. Confidence is great, but you have to be careful, and you don't want to become overconfident about your finances or anything else. So the thing that you want to do is make sure that the bad stuff doesn't happen to you. You don't lose your money. You don't suffer irreparable damage. The people that got hurt the most in 2000, 2001, and 2002, and then again in 2008, were the people that maybe were all in, overconfident, or not paying attention, not monitoring. So the key thing is you have to make sure it doesn't happen to you. You, meaning you stay involved, you know what's happening with your money, make sure you pay attention. You may have somebody help you, an advisor, help you with your money, but you make sure you pick the advisor, you monitor the advisor, you monitor your investments, you delegate, but you don't check out. And then make sure what's it? What are you trying to make sure doesn't happen? You're trying to make sure that you don't suffer a major loss. You make sure that your finances aren't wrecked by some sort of event, not just the stock market. Long-term care and other things like that can really blow a hole in your plan. So we're going to dig in with Dennis Miller. Stay tuned. Welcome back. More to talk about with your retirement. I'm very excited to bring back the author of Retirement Reboot and also Miller on the Money, and that's Mr. Dennis Miller. Dennis, welcome back.
Good to be here, David. Thank you.
Good to have you. Yes, sir. So I think for our audience, the thing that I really enjoy having you on the program is that you've walked the walk, you've talked the talk. I know that you did a lot of work for Fortune 500 companies during your career, your working career, but then you made the transition to retirement, but then you've kind of come out of retirement like a fighter. And you are guiding other people with your books and your newsletters and the things you do on what to be thinking about with their retirement. So I applaud your work, and I really enjoy reading what you're talking about, because so many people are looking at where we are in the world today, and they're saying, golly, things have never been this uncertain. How do we deal with this? And things seem to be changing so quickly. So I think you can share with the audience your perspective, because you've done what I call change the tire on the car while it's still on the track, which is hard to do. So speak to us a little bit about how things have changed and how people really need to come to grips with the reality just being different today than it was years gone by.
Well, David, you know, that's interesting you asked that, because I look back after my father's money and my mother-in-law's money. And in those days, things were different. They had a nice nest egg, and you could put it in CDs and bonds, and basically they were living off the interest, and they could enjoy life, and they didn't have to worry about it.
Yeah.
And of course, since the first bank bailout, where interest rates went right through the floor, the whole world has gone topsy-turvy when it comes to retirement money. I read something recently where it's not just the retirees and the baby boomers. It's affecting pension funds and their projections all the way down to people in their 20s now.
Absolutely. Well, and you speak to pensions, Dennis. You know, the thing that, you know, once upon a time, that age gone by, pensions were a big part of the retirement picture. You arrived at retirement with your house, and a lot of people, the American dream was to pay off the house. You had your pension, you had Social Security, and retirement was a long vacation.
Yes.
And what money you had saved also in maybe cash and savings and CDs, like you said, Dennis, they had put that money into things where it earned enough interest and they drew less than it made, and life was good.
Yes, exactly. And, you know, even while in the private sector, pensions are pretty much a thing of the past.
Exactly.
The major corporations couldn't afford to continue to fund it and invest it, so that they were responsible for helping people get involved in 401ks. But even with a person today who's had a 401k, you know, we had a magic number, and when we reached 65, if we hit that magic number, we could go on a long vacation.
Right.
And we did that. And I was 68 years old when they came out with the first bank bailout bill, and the vacation ended because they changed the rules. And I think that people are going to have to recognize that. You know, take a look at the jobs report. You know, if you look behind the curtain, you're going to find the majority of the jobs that are being reported in the jobs report are seniors coming back into that workforce. And it's scary because they're concerned about having enough money to last for the duration.
Well, if you think then about where people are today and the viewers who are watching this program, they're going, okay, I'm retired, I've got my Social Security, I've got some income I'm drawing, maybe they've got their required minimum distributions they have to take from their IRAs and 401ks. They've got these funds and they go, okay, well, I've got this, I don't know how long it's going to last, and I keep hearing that the market's at an all-time high or markets are volatile and there's always that risk. You know, speak to that, Dennis, because people, they just go, I'm not sure. Now, from a financial planner standpoint, I want them to build a plan, map it out, know where they're going to draw their money from. I don't want them drawing their money from money that's going up and down in the market. But people just kind of see all that and they go, gosh, I hope I'm doing the right thing.
And that's very normal. And I think that's part of understanding and coping with that because, David, you know, there used to be what I would call sure things. 6% interest. You could always get 6%. Not a sure thing.
No.
Social Security. I don't think Social Security is a sure thing anymore. And I'll tell you why. You know, what people don't understand, while there is theoretically a Social Security trust fund, basically that's nothing more than Treasury IOUs, okay?
Right.
If you were the president, and I'm joking here, of Enron, and you had your employee pension fund and you put it all into Enron bonds, you'd go to jail.
Yeah,
okay?
yeah.
And what's changed, and this is something you don't read about very often, is that up until 2010, the amount of money that the federal government got by taking Social Security out of people's paychecks covered the payments to retirees.
And then some.
And then some. So they just spent the rest of it on bills and put some more IOUs in the theoretical trust fund, okay? But in 2010, that flipped. So now, instead of having enough receipts from the workers to pay the retirees, now they're having to make up that slack. And David, I saw something, I believe it was on Heritage Foundation, by 2032, that's going to be something like $330 billion. So that means on top of the normal government borrowing that they have to do to pay all the rest of the bills, they're going to have to find a way to come up with another $332 billion to pay Social Security recipients. And you know, the politicians can continue to try to kick the can down the road, but it's not solvent. And sooner or later, probably closer to sooner, they're going to have to deal with it, and that nobody will be exempt. They're going to find means testing.
Right.
They already are talking about, there's a bill in Congress, and they've said it's going to be first talking points, of course, where they're going to change the cost of living adjustment formula and may eliminate the cost of living adjustment for high wage earners, which means middle class.
Right.
And the fact is they're going to raise the retirement age. You know, I told my son who's in his 50s, he may not get his Social Security till he's 70. And then they can change the rules. It's not like an annuity with a private carrier. You know you're going to get some Social Security when you retire.
Right.
You just don't know when. You don't know how it's going to be calculated. It may not be even in relationship to your income.
That's a
and they're
good
going to change it several times between now and even after you retire. So the fundamental, one thing we could count on of Social Security, David, I've said this before and I'll continue to preach it. Your most valuable Social Security check is going to be the first one you get.
I don't disagree.
Well, you take away the cost of living
Right.
adjustment, it's going to buy less and less
Right.
and less. So now let's talk about all this other stuff that you talked about. Where are you going to make up the slack?
Exactly.
I don't want to be in long-term bonds today. They start raising interest rates, and you're either going to have a below-market interest rate or your principal, your capital's going to go down. The stock market's at an all-time high. I'd have a real hard time, David, putting a whole lot of money into the stock market with a PE ratio where it is. So the retirees today, regardless of whether you're 80 or whether you're 40 thinking about it, are going to have to find a way to supplement their Social Security safely. And that's the challenge, because no matter what plan you put together, it's got to be flexible. And
Well, all plans are carved in Jell-O because they have to
Great
be.
line.
Yeah, they have to be carved in Jell-O because so much of this can change. And I agree with you, Dennis. I think Social Security, people, what they're going to receive, it's going to change. Now, I think politically, you're right, they're going to kick that can down the road as much as they can. And for people who are already retired, most likely going to receive some sort of Social Security. It may not be as much of an increase, and it may become at some point needs-based or income-based, or that's all political speak for if you make a lot of money, you may not get as much as the other person. But I think you've hit a real key point, Dennis, and that is that there's going to be changes, so you better be ready to adapt, whether the market's high, the market's low, somewhere in between. You want to have a diversified portfolio that brings things in together. You're not all tied to, you know, the S&P 500. You've heard people say, well, golly, if I'm going to hire somebody to manage my money or I'm going to have to pay fees, I'll just put my money in the S&P 500 and I'm done. Well, you know, that's all well and good, but then when the market drops 40%.
Worse than that, David, I've had somebody sit down and say that to me, and their attitude is, the S&P 500 always comes back. And the answer is, as a retiree, can you guarantee me it's going to come back in my lifetime?
That's the key question. Because it may not.
It may not. I mean, go back to, you know, what was it, 25 years after the Great Depression. And that's the point. Maybe the S&P is going to come back, but you can't guarantee me it's going to happen in my lifetime.
You better not be counting on it for your income. And I think that's where people get tripped up. And again, it's because they're used to this traditional approach that you talked about, Dennis, where we put the money in, we're going to make 6% or so, I'll draw 4, everything's hunky-dory, it's all good. But that's not realistic today. You can't be drawing the money you're living on from money invested in the market and expect to avoid or remain unscathed by a market drop.
David, I'll tell you how bad it is. A lot of publicity about the California pension, CalPERS. And I read an article recently where they're now $19 billion underfunded. And that was based on changing their projections to like down to 7.2% and down a little bit further.
Right.
But then the pension consultant said, realistically, they have a 75% probability that they cannot achieve those goals 7 years in a row, which means you got a 25% shot at it. And David, with all the horsepower, all the PhDs, all the computing power, all the analysts, if they can't do that, how's the average person, even working with someone like yourself, going to have a shot at having that kind of probability? The one advantage we have is that we can change on a dime. We're not trying to unload, you know, $4 billion worth of company stock.
That'd be a good problem to have, though.
Yeah, yeah. But the fact remains is that if they can't do it, I think the real message for retirees today is you better stay on top of it. You can't abdicate it to somebody else. And you're going to, whether you like it or not, have to actively manage your money until you die.
And think about it differently. Think about drawing from your principal and having to take interest and income or part of the principal and try to rebuild back by investing longer term some of your money.
David, there's no way I can explain it. But when I retired, I could live off the interest and never have to touch the principal. I played by the rules, all
Yeah.
the numbers worked out. Now I'm finding a lot of my peer group are finding that they're having to eat into
Right,
that.
right.
And you know, it's something that people can't understand until they've been there. I could sit down, David, and you could show me, Dennis, here's your money. If you do this, if you do that, unless you live to be 122, you got plenty of money to last you the rest of your life. And David, I don't care how many times you tell me that, I still have a knot in the pit of my stomach.
Right.
What if this happens? What if that happens? That is, you have enough to last you 122. Then again, if something else doesn't change.
Right.
You know, like healthcare costs, like means testing Social Security,
All of those things.
or something we haven't even thought of.
So-
and that's scary.
Monitor, remain nimble, know what you have, don't abdicate responsibility, stay involved, ask questions if you're not sure about what's happening with your portfolio, and please, probably biggest of all, the big one for me is that don't build your financial plan on rosy assumptions. You know, once upon a time, financial plans were built on, hey, we always make 12% average return. Well, I think after 2000 through 2002, a nearly 50% drop in the market, and then a 40% drop in 2008. I think people learned that lesson. Most people did, but there are still financial people that talk about, well, you know, we can get you 12% a year. It's not realistic.
It's not realistic, and the sad part is, you know, and you and I have talked about the difference in the planning level, where you have to look at it differently than, say, somebody who's working for a major brokerage firm with the suitability versus a fiduciary. And that I'm still seeing things in brokerage houses where they say, look, it's always average this, just put it in there, it's going to average it for the next 15 years. And that's what they've been trained to say. And they're young enough that they haven't experienced the fact that maybe that's historically the way that's worked, but this world is different today.
Yeah, that's
and you
true.
know, you talked about the political side of Social Security. You know, I don't care whether it's Democrat or Republican, Libertarian or whatever, their politicians are going to continue to kick the can down the road, hoping that somebody from the other political party tries to fix it so they can take the blame. And you know, who knows what it's going to turn out like?
Yeah, that's
and
true.
it's scary because we're counting on that money for the rest of our lives.
All right, well, we're going to make sure you get your Social Security, Dennis.
Yeah.
You know, the thing that I want to leave our listeners with our discussion today, Dennis, is that the reality is that these things are going to change, and we know they will. So be willing to adapt, be willing to get a fresh perspective. I tell people all the time, if you're not sure, get a second opinion. Get somebody to step back from this and look at it. And a lot of times for do-it-yourselfers, they really can't see the forest for the trees. They're so close. They're studying the bark of the tree, Dennis.
Yeah.
They can't see what's really happening without stepping back and maybe getting that opinion.
I think there's another side to that, David, too, and that is you still want to enjoy retirement.
Sure.
To me, a healthy retirement is being able to enjoy life without having to constantly worry about money. One thing that I've learned since I've been retired is that when you understand the big picture, yeah, we know we're going down the road and there may be some twists and turns in the road. But the reality is, once you're comfortable with that, you can live with it so that you're not constantly worrying about money. You kind of feel comfortable that you're going to be okay as long as you keep on the track you're on. And I think that's important too, is a good plan helps you enjoy retirement.
Just carve it in Jell-O.
Yeah, right, for sure.
Dennis, thanks for being with me today. Very
Thank you, Dave.
insightful as always.
Thank you.
All right, time for viewer questions. Now, today's question requires a little bit of setup. I originally had written an answer to a question to someone who reads my column in the paper, and I wrote the column, and then my mom sent in a question to me asking me more about the subject. So I want to use her question, because of course it's a wonderful question, to make a point. And her question was about an annuity and whether or not an annuity could offer a certain guaranteed rate of interest, and if the fees could ever eat into the interest you earn. So let me answer Mom's question, and it's an excellent thing to understand about how annuities can work. The question first really started with a gentleman asking me about an immediate annuity, and it was something he'd read in a magazine where the particular magazine was promoting the immediate annuity as a way of getting income. It was easy, it was simple, It was, didn't cost anything, and it sounded really good to him. And so he wrote to me and asked me about it. And I explained to him, and I'll share with you, that there's always a cost to any investment, number one. Number two, the cost may not be obvious. It may be buried in the product itself. If you go to the bank and you buy a CD, is there a cost of buying that CD? Yeah, you don't pay a fee on the CD, but the cost associated with the bank operating affects the return you get. So it's already netted out. So some products have fees built into them that you can't see, and that they're just not built that way. Other products, there is a fee that's very clear if you ask about it. In other words, the fee is there and it can be known for that particular product. And so this all led to my describing in the original answer to the question that some of these products have fees, some of them don't. And my mom asked me to follow up on it and explain that if you have an annuity and it has fees, can that fee eat into and eat up all of the return of the annuity? And the answer is yes. There are different types of annuities. Some of them are variable, and they are invested in the stock market, primarily variable annuities. There are fixed annuities that earn a fixed rate of interest, and there are index annuities that your money is protected, but the interest varies according to being linked to the stock market. Those are kind of an oversimplification, but those are the major categories. And then you have the immediate annuity that the gentleman had asked me about, where you put your money in and the insurance company basically gives you a pension. So with each of these different types of annuities, there are advantages, disadvantages, there are fees, either implicit or explicit. They're either built in and you can't see them because they're not constructed that way, or they tell you exactly what it is if you ask. So with all of this, you have to consider which one makes the most sense for your situation. There's no perfect investment, and I will remind you, and this won't be the last time I do this, is I'll remind you that whenever you look at a product being offered, you have to know whether or not that's the only product somebody can make available, it's the only one they can offer. If you see it in a magazine or a publication, on television, wherever, is that the only one that that company offers? Is it the only type they offer? Are they getting paid for it? How are they getting paid? If you see it in a magazine, who are the advertisers in the magazine? You know, you've got to ask questions and always couch and have a framework or a reference for whatever's being recommended to you and why it makes the most sense. If you'd like me to answer your question, just send me an email. I'll be happy to do it. The invisible man, that's who they were fighting. A couple came in my office and they said, you know, we've been investing for a long time on our own, and we feel like we're making progress for a while, and then all of a sudden it's like we get bonked in the head by somebody we can't see. And it's like we get our whole plan overturned by something we don't expect. That's the nature of the market. That's the nature of the beast. So the analogy is obvious in this situation. It's like fighting the invisible man. You know, the classic H.G. Wells story. I won't spoil it for you if you've never read the book. Make sure you do if you haven't. Excellent story. So when you're trying to deal with something like that, an unseen assailant, somebody you can't see, that is a good analogy for the market. What do? Well, you don't go out by yourself. You sequester yourself and protect yourself from being in a situation maybe where you shouldn't be, where it's not safe. Maybe you try to do some things to monitor the situation better. If we were fighting an invisible man, we'd maybe have a can of spray paint, try to illuminate the situation, see what's happening. So the key is to know that you can't know everything. The key is to know that it's difficult to predict the future. The key is to know that things are unpredictable. And prior performance is not necessarily indicative of a future result. There's a reason why the financial industry says that. It's different this time. There are things that will change and be different. Will we have another market correction? Sure. They're not infrequent. They happen about every year or so over the last 100 years. So there are things that can happen. You just have to prepare yourself. Take the time to plan, but trying to time it, trying to fight the invisible man, trying to outmaneuver what you can't see coming, not a good idea. Be careful, Take steps. You'll plan stronger.
If you would like more information about the topics and our guests featured in this series, please visit our website at PlanStrongerTV.com. Also, if you have a question you would like David to answer, please send it to questions@PlanStrongerTV.com.